Welcome to this video recap of Operation Marooned. We'll be looking at island reversals, the impact of the dollar, and key market outflows observed on Tuesday, June 23, 2026. Before we begin, please remember that this content is for educational purposes only. It is not a recommendation to buy or sell any assets. Always manage your own risk. In this video, we will cover the recent contract roll, analyze island reversal gaps, discuss market demarcation levels, and review key catalysts like the VIX and upcoming economic data. Here is a snapshot of the session. Indexes saw a drop of about 4% from intraday highs, with the NASDAQ showing significant weakness compared to the S&P. Moving into Act 1, the gap and the island. We saw a return to the contract roll, which resulted in a textbook island reversal pattern across major indexes. The S&P and NASDAQ both returned to the exact level where the futures contract rolled. While these levels act as magnets, they aren't guaranteed outcomes, so we always look at the facts first. Why is the roll gap a magnet? Futures contracts shift on a set schedule, creating a price discontinuity on the chart. Traders watch these levels, creating a self-fulfilling effect. Most traders react to institutional levels. Our goal is to help you understand these moves ahead of time by focusing on the read, rather than just the reaction. Switching to an OHLC chart makes the structure clear. By stripping away noise, you can see the gap up, the session, and the gap down, which forms the island pattern. An island reversal is defined by a gap up, a session in between, and a gap down. This pattern is visible across the S&P, NASDAQ, and NDX. The pattern is consistent across all three indexes. When you see a repeat of this shape, it warrants serious attention as it moves beyond mere market noise. Is it a reversal or just noise? On the positive side, these patterns can resolve themselves over a few days. On the negative side, they may confirm a turn, shifting the burden of proof to the bulls. The typical window for this pattern to play out is around 3 days, providing the runway for our trading decisions. It is worth noting that we are seeing these reversals on what were previously leading sectors. Being aware of this fresh development is critical. To conclude, this pattern is textbook, but it doesn't necessarily signal the end of everything. It simply means the market must sort itself out. Looking ahead, our first step is to monitor a retest of the lows. We need to see if the floor holds, or if we have further downside to navigate. Next, let's discuss demarcation lines. I primarily use 12, 22, and 55 period moving averages. While crosses can be noisy and chop, they become significant indicators when a clear trend is established. The December 22nd 55 framework is about having one job: identifying trend strength. While you can adjust these settings to your comfort, the core concept remains the same. Notice how life was easier when price remained above these lines. As I always say, context is the edge. Crosses are meaningful only when a trend is present. When you see a cross with an established trend, it demands your attention. Not every cross is the same. Some negate themselves quickly, while others, like a break below the 55, can signal a deeper trend shift. It's important not to rely on a single tool in isolation. Using the 55 as a demarcation gate is key. Staying below this line suggests a potential downtrend, while reclaiming it can negate the bearish signal. It helps us filter out the noise. Never trade a cross naked. Always overlay additional structure like put walls or the 55-day average. This stack of signals is what turns simple noise into actionable information. This recent cross, combined with the island gap we discussed earlier, is a clear signal to be cautious. We use these indicators in conjunction to gauge whether a downtrend is truly gaining momentum. In Act 3, we focus on specific levels and the VIX. We'll look at the placement of the 55, current put walls, and why the VIX behavior during recent intraday moves raised concerns. Currently, we are sitting about 1% away from testing the 55. I don't know if this is a structural break, but at this stage, a test of that level seems highly probable. Here is the map for tomorrow. We are watching for a test of the S&P 55, while keeping 725 on the SPY and 700 on the Qs in mind as our primary levels to monitor. When looking at the spread, the Qs took the brunt of the weakness, while the SPY held up slightly better. Understanding these differences helps us identify where the real market stress is located. Regarding put walls, they act as important defensive zones. When price holds, they are floors. When they fail, they often open up air pockets. The Q's put wall at 700 is a level to watch closely. The VIX behavior was particularly notable. On a 4% down day for the indexes, the VIX failing to close over 20 is a signal that suggests potential unfinished business in the market. When fear refuses to bid during a sharp pullback, it's a detail you want to notice. Stay vigilant, keep your levels in mind, and continue managing your risk appropriately. Let's look at the VIX, specifically the 20 level. Even on a day when indexes dropped roughly 4%, Volatility refused to spike and couldn't close above 20. This complacency during a sell-off is a warning sign that the downward move may not be finished. When assessing the current levels, it's a difficult spot, but not disastrous. I've seen far worse. My approach is to wait and see. We aren't even near oversold conditions yet, so I remain cautious. Moving to Act 4, the dollar's impact. The US dollar is currently breaking out well above par. This is the primary macro event we are tracking, and its influence is spreading into nearly every other asset class. Why is the dollar the main story? It's been rallying continuously, and the Fed is undergoing a regime shift. We are seeing shorter, simpler statements, no forward guidance, and a market that is fading the dot plot entirely. What specifically changes at the Federal Reserve? Guidance is gone, and the dot plot is being disregarded. Press conferences are no longer guaranteed as they move toward a more background role, despite maintaining and adding staff. As noted, this shift creates uncertainty, reminiscent of the Greenspan era. Because we no longer have clear signals, market participants are buying the dollar, essentially trading the uncertainty. The Greenspan playbook centered on creating maximum uncertainty as the default. Markets weren't forecasting. They were pricing a question mark. Returning to that approach is, in my view, how it should be. Frequent press conferences add unnecessary market stress. By stepping into the background and removing that noise, the Fed has shifted the landscape, which is why capital is currently flowing into the dollar. How does this strength affect the tape? It starts with rising uncertainty, moves into a dollar bid, creates stress in the carry trade, and ultimately causes strain across various cross-assets, from ETFs to export-heavy companies. A key field note on the yen carry trade. It involves borrowing cheaply in yen to invest in higher-yielding assets. It works until the currency dynamics shift, making the borrowing expensive and forcing an unwind. Looking at the 2024 carry unwind versus today, we see a familiar pattern. The trade pushed higher post-Fed, mirroring the setup that preceded the last major unwind. It is not yet a panic situation, but it is one to watch. Japan held an emergency meeting with the U.S. Treasury, which is a significant indicator of stress. While it is just one of several issues, watch the yen and the dollar closely, as this could feed wider outflows. My macro verdict is that the dollar is currently the primary driver of market strife. That strife manifests as outflows, and for now, everything else is secondary to that singular dynamic. Act 5. Korea and the outflow cascade. We saw pressure on Korean markets overnight. It is crucial to distinguish this from an earnings issue, which is not the case here. To be clear, there is no earnings problem. Corporate performance remains strong. The market weakness we observed was driven by currency and policy headlines, not fundamental issues with earnings. We look to upcoming reports to confirm this. Last night, EWT faced pressure from three catalysts. First, the shift as Hynix surpassed Samsung. Second, warnings about the dollar's impact on local currency. Third, policy talk regarding taxes on unrealized gains. These factors, alongside an unremarkable earnings print, created significant market pressure. Outflows rippled through the sector, centered on the Korea Fund, EWT, and the Taiwan Fund, EWT. Semiconductor ETFs like SMH were also tagged, and algorithmic trading accelerated the decline. The movement in these ETFs heavily impacted the heavyweight names held within them. Noise persists around potential demand destruction for the iPhone 18 due to its high price point. While some fear this impact, the reality is that if Apple doesn't source these chips, others will. Ultimately, this volatility is a currency story, first and foremost. There is a debate over iPhone demand. Bears argue high prices and rising costs will squeeze margins and cool demand. My pushback is that market demand for chips remains robust, and iPhone sales are likely to continue regardless of pricing, while the current policy noise needs time to process. A simple chain reaction links a local headline to our market environment. It begins with outflows from Korea and Taiwan funds, which trigger selling in US ETFs. This impacts semiconductor names. And finally, algos amplify the trend. We are watching this interconnected contagion closely. Understanding the ETF plumbing is crucial. Shared supply chains and overlapping holdings mean that when funds like EWT and EWT bleed, US ETFs suffer too. Outflows in these semiconductor baskets quickly pull down heavyweight names like Micron as algorithms react to the trend. As we've seen, when outflows hit certain sectors, they act as a trigger for others. This creates a chain reaction, where the market essentially falls upon itself as algorithms respond to the sell-side pressure. The fundamental verdict is clear. This tape is being moved by a currency shock, not an earnings miss. Expect this effect to ripple from Korea to Taiwan, and finally into US semiconductor ETFs as markets share their outflows. Heading into this session, I initially suspected a shakeout before earnings. However, the persistent selling behavior revealed a more calculated motive, the market wash-hunting for liquidity. To read the behavior, look for the lure. The market pushes price above key levels in VWAP, only to drop it back down immediately. This brake pedal signal is a classic trap. Micron provided the perfect example, never testing those levels again after the initial lure. The reclaim and reject trap follows a pattern. RSI lifts, price breaches a key level, then quickly rejects it. This confirms they were fishing for demand to offload supply. Especially after the first few hours, this activity is a clear warning sign for traders. We see the same pattern across different names. SanDisk dropped below VWAP after being pushed over, and the semiconductor index similarly reversed off its level. These are subtle yet vital signals that lure traders in before the rejection occurs. Respect the first 2 hours of trading. The lure is often built into this early period to trap people. While my setups usually hold water, I always put on the brakes when the market repeatedly pushes over levels, only to drop immediately. Prioritize behavior over hope. In the same session, day trades and swing trades saw vastly different outcomes. Day traders could fade the lure effectively, but for those holding swings, it was a rough day as the market was clearly hunting for liquidity. Ultimately, when the market gets you over a level just to reverse, it's a trap. They were looking for supply, not demand, and the price action was designed to lure participants in before the inevitable reversal. Moving to the behavioral verdict, they lured price over the lines and actively hunted supply. This is a clear indicator that something significant is happening under the surface. When you see the market tag a level, don't just take the bait. Especially in those critical first 2 hours, prioritize watching for the reclaim then reject pattern. We are heading into a catalyst gauntlet. This includes a decent earnings print that was sold down, Micron at the plate, PCE data on Thursday, and a quarterly rebalance. We will navigate these in order. Regarding the first print, the stock closed at 226.72 before the announcement. Despite decent results, it traded down to 208. We are now watching the 200 put wall and the critical support line at 196. It did everything right, beat expectations, and raised guidance. Yet, it is still being sold. This behavior is exactly what links it directly to the broader problems we see with Micron. When good results are not good enough to hold the price, it is a warning. This specific market reaction is a precursor to the challenges we expect for Micron. The most important takeaway isn't the earnings call itself. It is the fact that even with a decent print, the stock is being sold down. That is the tie-in to the Micron situation. We've seen this before. Last time, the earnings were fantastic, yet the stock dropped from 462 to 311 amid macro volatility. Is a repeat a risk? Yes. Micron earnings arrive tomorrow night. We must clear that hurdle before we can even turn our attention to the PCE data on Thursday. Looking back, fantastic earnings couldn't prevent a 150-point drop during a macro shock. That is the risk we carry into tomorrow night's events. Our operations are sequential. First is the Micron event tomorrow. Next is the PCE data on Thursday. Then, the quarterly rebalance. And finally, we judge the landscape. Don't look at this setup and assume you know the outcome. Recognize the likelihood of a retest and decide if you'd rather get that volatility over with now. Thursday's PCE is the Fed's preferred inflation gauge. With the dollar rallying and guidance absent, the market's reaction to the number will outweigh the data itself. Quarterly rebalancing causes benchmark and fund flows that can mask or amplify the underlying tape. We will cover this in detail tomorrow. My hope is that we don't rally without retesting lower levels first. I would rather rip the band-aid off and deal with the volatility now. Looking at the world, I break it down into 3 core components: what is happening, who is affected by it, and the technicals that dictate when it is the right time to take action. My process is top-down. I start with the index, then move to the sector, and only then evaluate the individual stock. If the index isn't cooperating, I don't force trades into individual names. Every level requires analysis. Macro trends define the what and who, while our technical indicators define the when. This approach creates a balanced perspective on market volatility. We are looking at 3 potential paths for tomorrow. Our base case involves a move down to test the 55-day moving average. The setup currently suggests that a return to that level is highly probable. In our base case, we are watching the 55-day support closely. If the market dips to this level, we need to determine if it will hold, especially with the current proximity of about 1% to the SPY 725 magnet. On the bull path, the goal is to hold the 55-day level, regroup, and reclaim previous highs. We need to neutralize the island gap and show that the market has room to run, as we are not yet in oversold territory. The bear path is defined by a close under the 55-day average. If the island remains above and we lose this support, the market faces a cascade triggered by outflows and algorithmic selling, leading to a retest of the lows. My watch list for tomorrow centers on Korea and the dollar. The dollar remains the master variable here. We are also watching Micron's reaction. not the earnings number, but how the price actually responds. Finally, I am monitoring put walls and leadership in the software sector. If our leading names slip under their 55-day averages, there is effectively no market support for us to lean on. Managing risk overnight is about patience. We are not yet oversold, so don't force a trade or catch a falling knife. Let the index clear its path before you decide to engage. Currently, we are at 0% on the oversold scale. The market hasn't reached the extreme levels that typically signal a strong buying opportunity, so staying cautious is the right move. The day's suck salad is a mix of signals: technical islands, the dollar breaking out, and Korea-related fundamental headlines. Alone, they are manageable, but stacked together, they justify hitting the brakes. We are compiling our field manual with all the key terms and levels. Having these defined and in one place is essential for maintaining clarity as the trade session moves forward. Key structure terms like, quote, island reversal gaps and, quote, contract rolls act as magnets for price. Understanding these technical nuances helps explain why certain levels hold or fail during volatility. To stay informed, subscribe and hit the bell for updates. Remember, dull entries rarely work, and our goal is to identify the expansions in the market. Stay disciplined and trade safely.